Let's get straight to the big earnings then that came overnight. ONGC reported a rather good set of numbers. So now tell us, how do we analyze these numbers? How was the output? What was the realizations?
So the main number that we look out for in ONGC is the realizations that you spoke about right now. So the oil realizations, they were absolutely in line with what the street was expecting. And the gas realizations, there is what we are seeing some outperformance. Remember, the gas prices, they were revised from October 1st, 2018. And that is what is showing in the results. So overall, it was a beat on all parameters. We were expecting a margin decline sequentially, but the company has reported good margins. It has come in at 59.8% versus 56.4% on a quarter-on-quarter basis. Revenues are flat at 27,600 crore rupees, but EBITDA, that has increased by around 5%. We were expecting a 15% decline. In terms of margins also, a good performance. Profit after tax, however, is flat on a quarter-on-quarter basis. That is because the exploratory costs, they have gone up substantially. They're almost double on a quarter-on-quarter basis. In terms of realizations, that is coming at $66.58 per barrel. That is what the expectations was, absolutely in line with expectations. Also, the domestic production of crude oil has decreased by around 7% on a YOY basis. We were expecting that decline, so that is not a surprise. In terms of gas production, that has increased, so that is a good part. Not only gas production, even the gas realizations have increased on a YOY basis, and that is what has actually led to this outperformance in terms of ONGC numbers. Well, the brokerages, they have different views. Like Citi has a neutral call, target at 172 rupees per share. They say that the revenue is in line, but EBITDA, that is beat on account of lower expected operating expenditure. They also think that there is a room for the government to bring down their stake. DB, on the other hand, they've cut the target price to 187 from 216 rupees per share because they have revised their estimates for oil prices going forward. They maintain a buy given the inexpensive valuations and also sensitivity to the oil prices. But they also think the government policies, they pose a big threat to the stock price. So let's see how the stock reacts today. Expect it to do well in trade today.
Okay, all right. Thanks so much for that. So now let's shift focus to the pharma pack. Then Glenmark came out with its set of numbers. Ekta is with us to run us through how those numbers were. Ekta, morning.
Hi, morning. Well, it didn't look too bad in terms of the Glenmark numbers. So revenue was up around 16% and that was led by growth across the markets. There was growth in the formulation segment, there was growth in the API segment which came in, and primarily it was led by its mother markets, which is basically US and India. So US was up around 16.3%, and India was up around 15.4%. Remember, there is a base impact which comes through for the US, but nonetheless, it was a significant growth. EBITDA was up around 35% this quarter versus our estimates of around a 36% growth. So margins came in at 17% in line with estimates, and the profit growth was shy of expectations, but nonetheless was up around 11% to 116 crores. In terms of some steps that the company has taken, the company is planned to spin off its innovation business into a new company in the US. So that new company in the US is going to contain around 8 NCEs or new molecules under development. Plus, it's going to have a CEO plus a board. So it's going to be a completely separate entity in order to enhance the prospects of the innovation business. We'd obviously want more details in terms of whether or not there is a final divestment chance on this particular business or not. But as of now, this is what we're picking up. And the conference call is at 8:30 a.m. today. So I'm sure we listen in and get some updates.
All right, Ekta, thanks a lot for that. But moving on, Nestle will also be in focus because they reported their Q3 numbers yesterday. And Manglam is here with all the highlights. Hey, Manglam, morning.
Good morning. So, Nestle results were a miss on two accounts. The first one, revenues. Domestic revenue was okay. The international revenue was absolutely flat, which is why we saw an overall revenue growth of just about 11%. This compares with our poll of 12.8%. But that's a smaller miss. The bigger miss came in on the EBITDA front. We were expecting an EBITDA growth of close to around 12.5%, 13.5% or thereabout, and the company reported an EBITDA decline of about 5%, and that's on account of higher other expenditure. So the company has stepped up its marketing spend. So run you through the numbers quickly. The revenue came in closer to the 2,900 crore mark. We were working with a number of 2,935 crores. The EBITDA adjusted for one-off impairments, etc., came in at 614 crores. The cnbc TV18 poll, as well as most of the brokerages on street, were working with a number upwards of 700 crores. We were working with a number number of 731 crores. The margins, we were working with a number of 25%. The company posted margins of 21.2%. And as a result of that, the net profit came in at just 342 crores, whereas the street was working with a number upwards of 400 crores. A CNBC TV18 poll suggesting a number of 446 crores. So where was the revenue misled by? Well, domestic revenue, that one grew by 12%, pretty much in line with what the street was working with. But the export revenue, which accounts for little in their overall pie, grew just flat, or rather did not grow at all. This against expectations of at least 7 to 8% growth. The management attributed that to weakness in UAE as well as Bangladesh. However, domestic revenues in line. Now, in terms of the EBITDA, gross margins were absolutely flat. The other expenses, they moved higher by 31%, close to around 808 crores, which explains the miss, for which the management says that they have stepped up their demand-generating activities for their new products. Over the last 1 year, they have launched a lot of products, which is what explains the support of marketing for them. By and large, the stock should see some decline today, given it's trading at 52 times, which is a pricey stock in an anyway pricey FMCG space.
Okay, all right, Mangalam, thanks so much for that.